Hello students, I hope you're all well, and in this video I'm going to show you how to prepare the cash flow statement of a company. This is an indirect method, and I have the question and the format of the cash flow statement drawn right next to it. So the technique is either it's a direct method or indirect cash flow question. Draw the format first, because that will provide you a guidance what you need to calculate. So as you can see that I'll be using this format of the answer, format of the cash flow as a guidance. So the first thing I need to record is profit before tax. So profit before tax will come from the income statement, and you can see it's 14,400. So I will record it as 14,400. Next is if there is any investment income, and I can see that there is no investment income in the profit and loss account. There is only interest, finance cost, and the tax paid. So if there is no investment income, then I'm going to record 0 over there. Next is the finance cost. So you can see in the income statement of this company that there is a finance cost of £1,000. So I'm going to add it back into the profit. So the reason I have added it back is because I started this cash flow from profit before tax, and this profit before tax is after the deduction of the interest expense. And we have to add it back because I need to work out how much interest I have actually paid. Remember that paid can be different from the expense recorded in the income statement. So at this stage I'm going to add it back, push my profit back up, and then later over here you can see I will be recording the interest paid and deduct it. Next is the depreciation. So we need to find out how much depreciation has been charged to the income statement. So you can see that income statement is not showing me how much depreciation has been charged, but if I read note number 1 and note number 2, I can see that there is some information about the opening and closing balances of my property, plant and equipment, and related accumulated depreciation, and also the disposal of machinery, which is in note number 2. So I need to take information from note number 1 and 2 simultaneously in order to find the depreciation charge and the purchase of any non-current assets. And the best way to do that is to open a T account. So I'm going to call it working number 1. And this will be my property, plant and equipment account. And it's an asset account. Therefore, my opening balance, which is a brought down balance, will appear on the debit side. So 2007 and 2008. The opening balance of the building was 12,000, and the opening balance of the plant and machinery was £5,000. So adding these two together, my opening balance was £17,000. Looking at 2008, the closing balance of my building is £22,000 and the plant and machinery is £5,000. Therefore, my closing balance, which is CD, will be £27,000. Then in note number 2, I have been given some information about the disposal of my machinery. So the information is machinery which carried a value of £250. So the carrying value was £250, and carrying value is after the deduction of depreciation. Was sold at the beginning of 2008 for £350. This machinery had an original cost of £1,000. So the original cost was £1,000, which was reduced after the depreciation charge for the number of years we do not know, we do not need to know. It was reduced to £250, and then it was sold, disposed of for £350. So you can see there is a gain appearing in the books, which is actually a notional gain. It's not a real gain, because we reduced the value of the asset after deducting the depreciation and dropped it down to 250, and then when we sold it for 350, it looks like we have made a profit. But actually, if I compare it with the 1,000, we have not made any profit. We have actually made a loss. So therefore, this £100 is a notional gain, or you can say it's an artificial gain, which I will be recording in the format, because we have made an artificial gain of £100 from the disposal of machinery. But at this stage, I need to remove the asset which has been disposed of from this T account which I have for the property, plant and equipment. So this 17,000 figure is a mixture of all the property, plant and equipment, and in this 17,000, that 1,000 of value of machinery which has been sold is sitting, and therefore I need to deduct that 1,000 out of the £17,000. And remember, in accounting we do not erase figures, we always show the adjustments, and therefore the adjustment will be to record it on the credit side of the property, plant and equipment. And if you want to know the double entry of this £1,000 which has been recorded, then the double entry is disposal account is debit by £1,000, and the property, plant and equipment account is credited by £1,000. So now I will close this account. It's 27,000 plus 1 is 28,000. 28,000 minus the 17,000 gives me 11,000. So £11,000 is actually the value of property, plant and equipment which we have bought during 2008. So remember, we have 17,000 property, plant and equipment opening balance. We sold one property machinery of £1,000, so the opening balance has been reduced to £16,000, but the closing balance is £27,000. So the gap between 16 and 27 is the number of assets, or the value of assets which we have bought and we have paid for. So I'm going to record it as bank, assuming that we have paid for all this plant and machinery, or property, plant and equipment. So £11,000 I have spent to buy new assets. While I'm on this, I will open another T account and record the accumulated depreciation. Accumulated depreciation. The accumulated depreciation will have an opening balance appearing on the credit side, brought down balance, and the carried down balance will appear on this side. So let's have a look at the question. This time I will be looking at the opening accumulated depreciation figures, which is 1,000 and 2,000, so 3,000 needs to be recorded. So I will record the £3,000 over here. And the closing balances are 4,000 and 2,250, which is 6,250. Now, The machinery which has been disposed of, we need to make an adjustment in the accumulated depreciation account as well. So notice that I removed the asset from the asset property, plant and equipment account over here. And similarly, any accumulated depreciation that relates to that machinery needs to be removed as well from the accumulated depreciation account. So let's work it out. The original value of the machinery was £1,000, which has been reduced to £250 after the deduction of depreciation. So let's work out. The depreciation is the difference between the original cost and the carrying value, which is £750. So this is the total accumulated depreciation of this machinery which has been sold. As you can see that the opening balance of the accumulated depreciation is the total accumulated depreciation of all the property, plant and equipment. Therefore, the 750 that relates to that machinery is also sitting in that £3,000. And I need to remove that. And as I said, we do not erase figures in the accounting, but we make adjustments. And therefore, to remove £750 from 3,000, I need to record it on the opposite side, which is the debit side. And I'll record it as disposal. And if you want to know the double entry of this disposal, accumulated depreciation, then the double entry is accumulated depreciation account is debit by 750 and the disposal account is 750. Now I'm going to close the account. So 750 plus 6,250, which is the heavier side, the debit side is bigger, and that is £7,000. I will record it on the credit side, and the difference is £4,000. So notice that my opening balance of the accumulated depreciation was 3,000, 700 was 50, and 750 was subtracted from 3,000, but the closing balance is 6,250. So the difference is the depreciation charge in 2008. This is the depreciation charge. And if you want to know the double entry for this, the double entry is depreciation expense debit by 4,000 and accumulated depreciation is credit by 4,000 in 2008. So now I have worked out that my depreciation charge for the year is 4,000. This 4,000 is going to go into my format, and I will be adding 4,000 back in my cash flow statement. And the reason we are adding it back is because this 4,000 was deducted from the profit, which pushed my profit down. Now I'm going to add it back because depreciation is a non-cash expense. So we have to add it back to push the profit back up. Next is the amortization of intangible asset. There is no intangible asset in this question. There is no information about the intangible asset. Therefore, I'm going to record it as 0. Next, you can see that it says gain or loss recorded in the profit and loss account from the sale of property, plant and equipment. And I know that we have sold one machinery and we recorded a notional, an artificial gain of 100. So it was added in our profit and loss account, which pushed the profit up. But we know that it's an artificial profit, so we need to subtract it in our cash flow to push the profit back down. So I'm going to record it as £100, but with brackets. Next is gain or loss on the sale of intangible asset. We do not have any intangible asset, and therefore there has been no gain or loss on that. We did not sell any. Next is the movement in inventory and movement in trade receivables and movement in payables. And we are going to look at our statement of financial position, and I'm going to show you how to record the movement of inventory, receivables and payables in the cash flow statement. So here is our statement of financial position. We need to look at inventory figures. So you can see that in 2007 our inventory was £11,000, and in 2008 it has increased to £16,000. Now, increase in inventory means I have stock sitting in my warehouse. That means I have spent money buying that stock, and that stock is sitting in my warehouse, which means my cash is tied up in the stock. And to buy more stock, I need to spend money. So from a cash flow point of view, it is not good to spend more money on your inventory. And in my cash flow statement, I will be showing it as a negative figure, because my inventory is increasing. So 16,000 take away 11,000, and I'm going to record £5,000 because there has been a cash outflow. Next is increase in receivables. So you can see that I have my opening balance of receivables of £2,700, and this receivables balance has been increased to 9,950. Now, receivables are my customers from whom I have to collect money. And if my receivables balance is increasing, that means my credit control is not good. I am selling on credit, but I'm not collecting money from my receivables. So from cash flow point of view, it is not a good sign that my receivables are increasing. That means my cash is tied up outside the business. So again, it's a negative figure in the cash flow. So 9,000 take away 2,700, and it is 7,250. Next is the payables. As you can see that payables are over here. The opening balance of payables in 2007 was £11,000, and this payables balance has gone down to £8,000. That means I am paying my payables, and when we pay our payables, from business point of view it is good, but from cash point of view it is not very good, because I'm spending money, the cash is going out, there is a cash outflow. And because we are preparing cash flow statement, we are only focusing on cash inflow and cash outflow. So the balance of payables have gone down from 11,000 to 8,000, and therefore I need to record it as a negative balance, and that is £3,000. £3,000. Now the next thing I need to do is add 14,400 plus 1,000 plus 4,000 minus 100 minus 5,000 minus 7,250 and minus 3,000, and that gives me 4,050. 4,050. The next in the cash flow statement is to work out the interest paid and the tax paid. And as I said, interest expense recorded in the income statement may be different from what we are paying. And similarly, tax recorded in the income statement as an expense can be different from what we pay. We may pay more than what we have recorded in the income statement, or sometimes we pay less than what we have recorded in the income statement. So let's have a look at the question and pick up the information. Now over here in the notes, it is given that no dividend have been declared or paid in the recent year. Note number 4 says accruals are in respect of interest payable. So these accrual figures over here are actually for the interest. $700 and $200. And then in the income statement, I can see that the interest finance cost, which is 1,000, has been recorded as an expense. Now, I always encourage my students to open a T account and drop the figures in the T account. This way, you will not get your answer wrong. So what I'm going to do is to open a T account, and I will be recording interest expense. Interest. Now, as you can see in the question, that interest figures are recorded as accruals, and they are recorded as liabilities in the statement of financial position. So I can say that this is a liability account by nature, interest payable. And because it's a liability in nature, therefore the opening balance will always appear on the credit side. And therefore the closing balance will be appearing on the debit side. So the opening balance of the interest payable in 2007, as you can see, is £200. So I need to record this £200 as an opening balance. And then you can see there is a closing balance of 700. I'll record 700. Then I need to record this £1,000, which has been recorded as an expense in the income statement. And if it is recorded in the income statement as £1,000, that means it was debited in the income statement as an expense. So if it is debited in the income statement, then it is credited in the interest expense account. So I can say that income statement, and if you want me to write the double entry for this is income statement is debit by 1,000 and interest account is credited by 1,000. Now I need to close this account and find out the balancing figure, and that balancing figure is the interest paid. So 1,200, which is the heavier side, the credit side is heavier. I will record 1,200 on this side and subtract 700 out of it, and the difference is 500. That is the amount of interest paid. £500 is the interest paid. And I'll quickly update my cash flow statement, and I'm going to write 500. Now I'm going to show you that previously I added back the finance cost over here. I added it back 1,000, and now I'm subtracting the 500 because this is a cash flow statement, and I want to show how much cash outflow there has been. And you can see 500 is now being subtracted. Next is the tax. Looking at the tax figures, so we have opening balance of tax, which is 1,000. We have closing balance of tax, which is 1,800. And then we have tax expense recorded as £2,000. So I'm going to open a T account again. I will call it tax account. And you can see that this tax figures in the statement of financial position have been recorded under the liability, so I can say that this tax account is also liability in nature. And therefore, if it's a liability in nature, the opening balance will appear on the credit side. So the opening balance is £1,000 and the closing balance is £1,800. So £1,000 and £1,800 carried down balance. And in my income statement, I can see that it was recorded as £2,000 as a tax expense. So I'm going to record it over here, £2,000. Again, if it is recorded as an expense in the income statement, that means income statement was debited by £2,000. That means tax account was credited. The double entry is income statement £2,000 and tax account is credited by £2,000. Now let's close this account. The credit side is heavier. I'm going to write £3,000 over here, copy the same figure, £3,000, and subtract 1,800 out of it, and the balancing figure is the amount that has been paid as a tax in 2008. And that figure is £1,200. £1,200. So I'm going to record it as £1,200 tax paid. Now you must be thinking that I have in the income finance cost, I added the finance cost and then I subtracted the finance cost. Why didn't I do that with the tax? Notice that I picked up 14,400, which is profit after, profit before tax. This is not profit after tax, this is profit before tax. That's why I did not add back the tax, but I'll be subtracting the tax which has been paid. Next, I have 4,050 as my cash generated from operations. Then I will subtract 1,200 out of it and 500 finance cost out of it, and the balance is 2,350. Now, the next thing I'm going to do is to calculate the cash from investing activities. As you know that cash flow has got three parts: cash flow from operating activities, cash flow from investing activities, and then cash flow from financing activities. So looking at my investing activities, purchase of property, plant and equipment, and I already have T accounts in which I have worked out that we have bought assets for £11,000. So when we buy assets, there is a cash outflow, and the cash outflow is £11,000. So I'm going to record £11,000 as a negative figure. Next, purchase of intangible asset. In this question, there is no intangible asset purchased. Proceeds from the sale of property, plant and equipment. And I know that we have sold one of the machinery. So you can see the machinery was sold, and the proceeds, the cash we have received is £350. So this is a cash inflow. Therefore, I'm going to record 350 as my proceeds. Then proceeds from the sale of intangible asset. We do not have any intangible asset, so I'm going to record it as 0. Interest received. In the profit and loss account, you can see there is no interest income coming into this business. So we are going to record it as 0. Now I'm going to add the total of cash from investing activities, to work out net cash from investing activities. So £11,000 take away 3,350 is 10,650. Negative figure. The next part is financing activities, how the company has been financed. Proceeds from the sale of shares. Companies finance their business by selling shares. And in this company, I can see that the share capital has not changed. It's still the same, 3,000. So I can say that there has not been any sale of shares. And when companies sell shares, they receive cash. So I'm going to record 0. Movement in borrowing. So companies also finance their business by borrowing money from the lender. So loan, I can see that it was £10,000 and now it is £6,000. So we have loan in this business. The opening balance of the loan was £10,000 and now the loan is £6,000. So again, remember that this is cash flow statement. We are looking for cash going out or coming into the business. And when we repay our loan, there is a cash outflow from the business bank account. And therefore, there is an outflow. Therefore, I'm going to record it as a negative figure in the cash flow statement. Next is dividend paid in the question. Note number 3 says no dividend have been declared or paid in the recent year. Therefore, I'm going to record it as 0. So the total is minus £4,000. Next, net increase or decrease in the cash or cash equivalent. So now I need to add the totals, this total, this, and this total. So let's see what is the answer. So 10,650 plus £4,000 take away 2,350 is £12,300. So I have added this plus 4,000 and it is negative £12,300. £12,300. Then I need to record the cash or cash equivalent at the beginning of the year. So let's have a look at our statement of financial position. Cash or cash equivalent over here, we had the opening balance of £1,300. So let's record it. £1,300. So overall we have a negative 12,350, which is net cash in net increase or decrease in cash or cash equivalent. From the statement of financial position, I have picked up the opening balance of the cash, which is 1,300 plus figure. So 12,300 take away 1,300. The answer is negative £11,000. So cash or cash equivalent at the end of the year is negative £11,000. So let's check our statement of financial position. Is it true that our cash or cash equivalent is negative? So going back to my statement of financial position, you can see there is no cash or cash equivalent. Instead, there is a bank overdraft of £11,000. So now my figure of £11,000 overdraft, my 11,000 figure is matching with the cash flow statement of negative £11,000. Negative balance means overdraft. So this is the full cash flow statement. I hope you enjoyed the video and you learned from it. Please don't forget to like and subscribe. Thank you.